Thanks for tuning into Profit Insights. At times on Profit Insights, we try to talk to businesses which might not be the easiest to understand at first glance, and then try and understand what the longer term outlook from the head honcho of the business could be like. Now, that's the kind of conversation that I think we've slated for today. We're in conversation with Kabir Shakir of Tata Communications to try and understand how would the next 12 to 24 to 36 months pan out for Tata Communication after they having, in some sense, built a bit of a base over the last 3 or 4 years on the operational metrics. Kabir, thanks so much for taking the time out, and hope the month of Ramzan is going on well for you. We've decided to split this into 2 segments, Kabir. A small first half, a lopsided large second half. In the first half, we'll talk about the here and now. The second half, we try and talk about what you think about the future. So I'll start off with the here and now. Based on what you've done in the first 9 months, some bit of, from an analyst perspective relative to estimates, some bit of pressure, especially in Q3 on EBITDA, so on and so forth. How is the near term suited for growth, or will it be a period of consolidation?
Firstly, thank you. Thanks for being here with you, Niraj. I would say for us in Tata Communications, the last 3 years have been quite transformational. But this year in particular, is really, something which we will mark in our history, because this year we completed 3 acquisitions, and I think we did, few acquisitions probably a decade ago, and we've now come back, into the fray. But why am I particularly pleased about is that we got the balance sheet hygiene and the strength to be able to aspire for these acquisitions and bring these targets in home. They make a lot of strategic sense. They are completely aligned with what our strategy is and where we want to take the business. So this year has, therefore, we should see from that perspective as some kind of a first inflection point, in Tata Communications getting onto that fray. Now, leading up to that, what was the business 3 years ago, where we had quite weak, financial performance, a weak balance sheet. Our first marker was to get this business to a double-digit growth. And with COVID, that did take a little longer. Therefore, it didn't mean that we will not fire on other cylinders, whether it's EBITDA, whether it is ROCE, EPS, our gearing levels. All of them, were probably the best in the recorded history of Tata Communications ever. And then 4-5 quarters of consecutive double-digit growth is what we clocked in. And then we looked at it and said, what next? So we've now stuck our neck out and said, we will double our data business by FY27. Yeah. So from 14,000 crores, we will take this business to 28,000 crores. It has a mix of organic and inorganic, and when we said that, Kalera was not yet approved by the board. So I don't want to put a target on inorganic, because it will be irresponsible. Then you will go chase a target. We should do an acquisition if it makes strategic sense and it gives the right value to both the shareholders, and that's what we will pursue. And it so happened that we were lucky to get an asset like Kalera. We had closed, rather we announced Switch already, before this, this announcement that we actually made. So both Switch and Kalera, I think, are great strategic assets that we've got for Tata Communications. Now, the resultant impact of it, as you rightly called out, there was a pressure on EBITDA, but that is weighted average mathematics, as simple as that. You acquire 2 loss-making business, you acquire them at a multiple less than 1, in the tech sector. So obviously there are going to be some, hiccups, and that they were loss-making, and that's the reason why they were available to us in the first place. But I'm glad to say, in the very first quarter of closing and integrating Kalera, we have made them EBITDA break-even. In fact, they are EBITDA positive. And that's because the low-hanging cost synergies and the cost benefits, we started working the day we announced and had our plans between the announcement day and when we closed the acquisition. I mean, simple things like they are NYSE listed, SEC regulated entity. So a lot of costs that come associated with that. Within 10 days of closing, we delisted the entity from the New York Stock Exchange. So we have got now, great plans to capture the revenue synergies that we have, identified in the business case. So I would say, this year we will continue our growth trajectory. The three KPIs that I look from a financial perspective, EBITDA, ROCE, and net debt, all three will depart from their ambition range. Debt to EBITDA will come back faster, under 2x. We are probably at 2.2x now. We used to be 1.3. We'll come below 2x in FY25 itself. ROCE will take a little longer, a year longer, and EBITDA maybe 2 years. But that's the mode of investment that we will continue to push this company to. And that's the strategy on the finance strategy that I spoke to you earlier about. Our fit to grow strategy is to continuously reinvest, the benefits that we get from the business, to acquire capabilities, build capabilities organically, so we can go and capture that growth, and that gets into that virtuous circle that we want this company to get onto.
Okay. I'll end the conversation about, or maybe not then, but when does some aspects of this virtuous circle start showing meaningfully? And I will come to that, because somewhat of it might be showing as well. Maybe the street doesn't recognize, but you being at the helm of affairs kind of see that happening. But would be lovely to understand the numbers as they come out. But just to get the numbers thing out of the way, before I come to the overall strategy, etc., and how do you see the business? The estimates are of about between a 15 to a 20% revenue CAGR for the next 3 years from your business. The estimates are of average EBITDA margins of circa 25% at some point of time immediately. The estimates are of return on capital employed to be 25, 26, 27%. Are these reasonable estimates to work with for the next 3 years?
Yeah. Let me answer the first question on the virtuous circle, because that's close to my heart. It's already playing out. Why do I say it's playing out? The numbers are there to prove itself. We bought this, the Switch asset at $60 million, 59.8 to be precise. And the entire funding of that was done through working capital movement. We didn't borrow a cent from outside. Our gearing did not increase. Now, Kalera, on the other hand, is a much larger asset, and obviously, we had to borrow. We had to also acquire their debt. They had a $220 million, debt that we actually acquired as well, gross debt. But Switch was completely as a result of the virtuous circle of growth coming in through. We generated the efficiencies from within, released the cash from dead, unhygienic processes, better control on receivables, better capex efficiency, better tax efficiency, and all of those combinations gave us the cash that we can go and invest in a revenue generating asset. So nothing changed in our balance sheet, and we suddenly got $80 million of top line. So that's the virtuous circle of growth, working for you. Coming back on the estimates that you mentioned, I call them as our ambition, and I always like a range to give. And the reason why I like to give a range is that I don't want to be pointed to a point number, right? Because the economic cycles are going to be volatile, right? And the businesses need to be resilient enough that they operate in that range and still give a little bit of a certainty to the street as to that's the ambition, of that. Doesn't mean to say that we will not depart from that range for good reasons. Like while we were in COVID, we were operating north of the 25% EBITDA range, right? So we were generating more profit than otherwise we would have, we would have stated in the 23 to 25 range. So with that said, I'll come back and reiterate our ambitions. Yes, we would like to be in the double-digit growth, and if you say that we are going to double our business by FY24, you can do the CAGR. It's 18%, but I don't think it will go through organic every quarter, 18%, because there will be lumpiness, in the kind of growth aspirations that we seek, because of the nature of businesses that we are in.
Sure.
So that's, about the top line. On EBITDA, our stated goal is 23 to 25. That's the range that we would like to operate. This year, one can do the math because, we've announced the Switch numbers. Kalera is a public listed company. In fact, the street was slightly surprised, positively by our EBITDA number of last quarter. They actually thought, it will be a little lower than what it is because the cost synergies we actually got in and we delivered a better number. Again, hopefully in 2 to 3 years' time, we will get EBITDA back to the 23 to 25%. And ROCE is greater than 25%. I mean, that's my ambition, that I maintain the business generating a return on capital of greater than 25%. That's embedded in fact, all of our internal working processes as well, right? Whether it's clearing our capital proposals or any other value creating proposals that actually come in, they need to be generating that kind of a return. So we want to increase our capital outlay, but we want to also increase with an eye on returns.
Kabir, just trying to break this down for a few people who might not have a complete understanding. You've done 3 acquisitions, as you said. There's a very solid existing business. There's a lot of talk of private 5G related capex and what it will do for the company. So at the end of FY24, what is the revenue structure of Tata Communications currently, or the business structure of Tata Communications currently? What would it look like from a revenue contribution perspective or a business dynamics perspective, let's say 3 to 5 years out?
Let's say historically, what was Tata Communications? I mean, we were the VSNL.
Yeah.
We came from a heritage of a wholesale voice player. And we called out a few years ago already, even much before the arrival of Lakshmi, we called out that we would like to focus on data and not on voice. I mean, voice is a declining business. So I'm not going to talk much on voice, today. Let's focus, all our discussions on data, and even all our aspirations that we have actually called out on top line, doubling, is on the data business, right? The data business is actually made up of 2 components: the core connectivity, part of it, and then there is a digital portfolio. There are the 2 basic segments that we look at within the data business. And core connectivity is basically the network business that all of us are familiar with what Tatacom, wants to do. Our ambition is to move from being a telecom player to being a comtech player, and this is not a play of words. I mean, there is a lot of strategy and a lot of depth behind this restatement for the company. Bringing in services that we can use connectivity as a foot in the door, be the connectivity expert, but then provide value-added services to our customers so that they can get their outcomes that they want, for their organization. Whether it is borderless growth, whether it is improving efficiency, agility, collaboration, managing risks, or even for that matter, their end-to-end supply chain, being looked at in totality. So that's where all our products, come into play. Shape of the business, we were, before the acquisition of Kaleyra, 64% of our data business was core connectivity, and 36% was the digital portfolio and services. Shape of profitability, the core connectivity business, is largely profitable, very profitable, and the digital portfolio is negative to flat EBITDA. That's the shape that we are actually looking at. And why am I giving these inputs? So that you also understand, when I give my guidance or the ambition on 23 to 25, we want to first balance the portfolio of core connectivity to digital to be 50-50. Now, with the Kaleyra acquisition, we are already at 55-45. So the 36 has already jumped up to 45. We will soon get to 50-50. What does that mean? When you have the digital portfolio growing much faster, I mean, it will be growing at 25-30% range. The core connectivity is growing in low to mid single digits. Globally, the market is declining, but we are still growing in the declining market. India is, by the way, growing, and we would like to maintain our market leadership in India. That's our stated ambition. So the weighted average math basically means that the more that you grow faster on digital portfolio, the more strain you actually put on your EBITDA, because it's a lower, EBITDA profile, and that is actually growing, faster. And despite that, we are saying we will improve our, our EBITDA margin. And what does that play, out to be? It plays out to multiple factors. Operating leverage that we should start getting, from the business. There are still efficiencies that we need to strive for, and we need to get into that mode of continuous improvement. And unless and until we take the tall order task of improving the overall EBITDA, despite the negative mix coming from, the changing profile of this business, is what will, otherwise it's very easy to do the maths and say, oh, I'll be under 20%. But that will be irresponsible. Now, that's not what we would like to do. We would obviously like to walk and chew gum at the same time. We would want to deliver profitable, top line growth at the same time, at a competitive and a sustainable profit, margin as well. So that would be the shape, for you, that in the next 2 to 3 years, we will get back to our EBITDA profile. We will have a more balanced, if I may, skewed more towards a digital, services portfolio, shape of the business, which credibly makes us a ComTech player in the industry.
Does that, is that the future and hence the pursuit? And part two of the question therefore would be, at some point of time, efficiency-backed margin uptick, for example, will run out. There is only as much efficiency that you can bring because you are already presumably a fairly efficient player. So it's the longer term trajectory for a business like this. Could it be high teens margins, or would you believe that there are other levers at play which could help you beat what people would believe would be the natural course of margin trajectory?
Look, it is going to be a continuous game, and I would never say, that efficiency ever runs out in any organization. Why do I say that? Because context doesn't stop. Context keeps changing, Niraj. The external environment, whether it is interest rates, tax rates, supply chain, geopolitical trends, all of them are constantly changing and constantly evolving. So our enterprise customers are also looking for all of those efficiencies in their business on a continuous basis. So therefore, I would have the mindset of a continuous improvement in our, in our business. And there is obviously, efficiency. I mean, I've been schooled, from an institution which believed, cost is a waste. So unless cost is zero, then you have not attained an optimum, level. So, jokes apart, that is the mindset that we need to have. And on a serious note, I have a very, very simple rule. If there is a cost element in my P&L that does not face the customer, that does not add value to the customer, it does not have a place in my P&L. As simple as that. So it needs to be ruthlessly plucked and thrown out. And that is the zero-based approach that we actually go, through and through. So I do believe there is, more that we can, get out in that space. Plus, we have to get into the mode of dynamic performance management and a dynamic resource allocation. And these are not, jargons and empty words. What do I mean by that? We may have invested in technologies, and we'll continue to invest in new technologies. But each of them will be given a certain runway. If they don't deliver, returns, then those investments are going to be pulled back, right? And then we will, chop them off. I mean, my simple mantra is fail fast and fall forward, right? And in the space that you are in the technology space, if you do not take those risks, and if you're not the first mover, then you lose out. So we can't even wait to say, oh, let's wait till this technology is successful and then we will implement. Then you lose the first mover advantage and competition has taken ahead. So you need to have that approach where you are supporting risk taking, you are supporting entrepreneurship in the organization, but at the same time, I would say the balance of head in the clouds with feet on the ground. You need to bring that balance to say, okay, I'm going to drive this hobby horse, but whether it is 12 months, 18 months, they don't deliver the returns, then they're going to be pulled back. So we have many such I would say non-performing assets in the business, and they will be put to task, and therefore there will be efficiency improvement that will come from there as well, right? So there are it's a multiple such slots that we I would say play with to ensure that we are continuing to invest in our, we call it stage 0, 1, 3, which is basically the nascent stage of the innovation cycle that our products are in. So we will continue to fund them. So it's not democratic, approach. They will get the funding, whereas the other businesses will be under the spotlight to deliver the returns.
Got it. One final question, Kabir, and that is anything which you believe the street doesn't quite understand or appreciate about things that you're trying to do here, which might have longer term implications, which are, sorry for repeating, which are not quite understood well?
Well, I keep reminding people, in a digital transformation journey of an enterprise, there are multiple players, who actually come and contribute. Not everyone has everything. So therefore, this is also a typical industry where your competition is also your customer is also your collaborator, right? So you need to come together to actually provide those solutions. So quite often people confuse, and ask, what do you, specifically, do, and why are you doing this vis-a-vis an SI, or someone else? And all I, keep telling them is, it's very simple. What value can I add? I come in from the heritage of connectivity. So that's why comm tech, I'm not putting tech ahead of, of comm. It will be communication technologies. We understand connectivity, we understand communications like nobody else does. We have a global network, of network infrastructure,
yes,
communication infrastructure as well, which comes to the play. We service almost every Fortune 500, customer. 1/3 of the internet traffic goes through our routes, right? So we have, that is the capability that we have, and we can take that capability to our customers and then augment that, with the services. And I think there is magic to be had, and there are a lot of, use cases where Tatacom, is probably best placed to serve those, needs of the customer. Connected, solutions, whether it is automobiles, whether it is planes, whether it's, I think every, I would say, piece of business will be a connected business, connected with their supply chain vendors on one side and, customers on the other side. And I don't say only customers, but even what the customers use, right? The appliances that you actually sell, so you get intelligence, out of that. So one thing which is going to really, while AI is doing the buzz, all of that is going to be powered by connectivity.
Sure.
And once you have someone who actually understands that connectivity and then can give a solution and a service, on top of it, and that's the reason why I feel very, very inspired about what Tatacom has to offer for the customers.
Well, all the best, Kabir, and we'll keep on having these conversations as you keep on innovating and adding newer layers of growth vectors to your business almost every single year. Thank you for taking the time out and speaking to us today.
Thank you very much. Thanks for having me.
Now, the pleasure was entirely ours, and viewers, thanks for tuning in to this leg of Profit Insights.